Welcome to EAGTAX and our tax advent calendar, where we will be sharing tax tips and explanations in the lead up to Christmas. For day 12, we will be covering shares and capital gains tax. With the tax-free capital gains tax exemption set to reduce down from over 12,000 to 3, more individuals may need to report capital gains through self-assessment as a result. When calculating the gain on shares, there are specific rules to match the tax cost against the sale. This is mostly relevant where you have acquired shares of the same class and company over a period of time and you are not selling all of the shares held. Sales are matched with the same shares acquired on the same day, acquisitions in the following 30 days, then the Section 104 pool, which is essentially the cumulative total of acquisitions up to the date of sale. These rules do not apply to BES, SEIS, EIS or VCT interests, and there are alternative rules for HMRC approved share schemes. If the company declares a bonus issue, the only effect is to reduce the tax cost, as it is then spread between the enlarged shareholding. Alternatively, a company may declare a rights issue, the company offering existing shareholders the right to acquire further shares based upon their current shareholding. If you do not take up the rights issue, normally you will receive a payment. The CGT options include where the amount received satisfies the small test, the proceeds can be deducted from the tax cost, or where the proceeds exceed the tax cost of the shares, the whole cost can be offset. If not, the usual part disposal calculation method must be used. Where a company is subject to a takeover, you may be offered the opportunity to receive shares in the purchaser by way of consideration. This will generally have no tax impact unless you also receive cash. You may sometimes see the word equalisation in relation to unit trusts. This value is not treated as a capital distribution, but as a return on the price paid. This therefore reduces the tax cost when determining the capital gain. If a company becomes worthless, a negligible value claim can be made to bank the capital loss before the company is dissolved. HMRC publishes a list of shares and securities in companies that were previously quoted on the London Stock Exchange that have been accepted as being of negligible value. The current capital gains tax rate for shares and unit trusts is 10% for those with income and gains which do not exceed the higher rate tax threshold and 20% who breach this threshold. If married, you can transfer shares and unit trusts between you without tax consequence, so long as you are UK domiciled. This may assist with utilising annual exemptions or lower tax brackets. If you have a managed portfolio, it is likely the platform will provide CGT data automatically. Remember, you can also introduce £20,000 into a stocks and shares ISA annually, which then renders capital gains tax irrelevant. We hope you found this useful. Please take a look at our website for more information and contact details at eagtax.co.uk.